Good afternoon, everyone, and thank you very much for joining us today. Both Ivan and I are working remotely at the moment, so we're working from our home internet connections, which has got its own set of challenges. And
by the sound of it, we might have to get used to it soon.
Yeah, possibly. So anyway, so we're both sitting here doing the right thing as we in the current environment. Our office is working on skeleton. Both our offices are working on skeleton staff in office, and that will be continuing over the coming weeks until we get a handle on what's going on in the world at the moment. But it is all very surreal out there on the streets, and the market accordingly has had its own set of challenges. So thank you to all the people who were on the session the other night, where we covered off how we've been trading and so forth, and we went through a number of trading strategies. Our open positions are both Ivan and I closed out of yesterday, and we're looking at the market with much interest today, especially as it's pulled back down towards the 500 levels. And I get nervous saying anything about the market unless I'm looking at the market at the moment, which I'm not, because it moves so quickly. I know Ivan and I have run webcasts where we've sort of been in the middle of talking about the market, referencing it, and then looked around, it's down another 100 points. So it's very volatile conditions out there, and that has influenced how we've been trading, and also will influence the style of strategies, and may even in some instances, as we're going to refer to today, lead you to modify your trading rules, because we're not trading in a normal market. So the technical rules that we build for day-to-day trading may still apply in many instances, but the way we trade them, you need to consider that, maybe even modify slightly depending on exactly what rules you've got and what strategies you use. So we'll talk about that a little bit more. My name is Patrick Nelson. I'm MD and founder of Reach Markets. Background as an options trader. I've been trading options for 2 decades. The education partner to the Australian Stock Exchange. Have run one of the busiest options desks previously in another life, or pre-Reach Markets. And Reach Markets has become one of the busiest options trading desks in Australia over the last 6 months. But we're quite a young business. I think we're 16 months old, so we've grown very, very quickly, and it's happened off the back of the investment in building the best technology, without question, if you're an options trader in Australia. But we believe that the service and support for traders, it's not a discount model, it's not a low-touch model, it's what you need when you need it model. So if you want to trade online at the lowest rates possible, you can trade on our platform. If you want to use the best technology to price up your strategies and get information and speak to an advisor to help you trade, you can do that as well. So, we invest heavily in trying to educate, provide support. We're investing heavily in building, having quants, analysing trades, and coming up with better information for you to help you with your trading. So anyway, so it's a little bit a partner in the Reach trading side of the business is Ivan Cherrylove, who is the co-founder of TradeFloor, along with Brock, and they've built amazing technology for the market. In a very short period of time, it's become the dominant risk management system for Australian brokers. And now that has come through Reach Trading implied volatility system to the retail market as well. A very experienced trader, traded from a very young age, traded very successfully from a young age, independently and then professionally, and then has subsequently forged a reputation, is very well known in the industry. And that is Ivan. Ivan, welcome today.
Thank you.
So any advice contained in today's presentation is general only. It doesn't take into consideration your personal circumstances. You need to decide for yourself whether it's appropriate for you. Past returns are not an accurate indicator of future returns. And if you haven't worked it out yet and you're an options trader, we say it every time, options, if you're trading them, are a risky instrument. You need to know. We'll be doing a trade group discussion tomorrow, and that's generally for our members. And for anyone that wants to take a trial of our trading platform, get access to our trade ideas, get access to all our education, you can take a free trial. All you need to do is type in yes into the chat box, and we'll organise that for you. So just type yes into that chat box. At any time during the presentation, we'll organise to get you set up. All right. So here is the chart of Coles. It doesn't look like this quite at this of trading in the current market. And when we're trading, we're talking about the first strategy we're going to go to and look at is trading breakouts. And when we're trading a breakout, we're trading on the basis it's either going to be a breakout or a fake out. The important part of that is that we're not locking ourselves into one view when we go into the trade. We're saying we think the market's going to go up. In this instance, Coles had broken the 52-week high, not in a particularly confident way, but it had broken it, and it met our rules for a breakout trade on the upside. But when we go into this trade, we'll be looking at it going, is it going to be a breakout or a fake out? Now, what we're expecting in the current market is if it moves, it's going to break one way in a significant way, and we want to make sure that we can position ourselves to be on the right side of it, even if when we initially get into the trade, we are not, right? So our big view on this is it's going to move up or down a significant way when it's trading from a pivot point. We want to be able to make money out of either of those scenarios, all right? So let me keep clicking through. So the questions that we ask ourselves when we're trading a breakout is the share price above major resistance, in this case the 52-week high, and this morning it was. Is the 50-day moving average above the 200-day moving average? Yes, it is. Is the 50-day, so that red line here, so it's crossed over, and we spoke about this the other night on the webcast for those people that were there, and you can go back and watch the recording. If not, it was recorded, and I believe it was sent around, but if you need it, just request it, or it will be in the morning report, be updated there. So the next question we ask ourselves is, a golden cross occurred, is this overall trend up? And it has been. So is the 50-day moving average, 200-day moving average? Yes. Is the share price above the 50-day moving average? Yes. Is the 50-day moving average trending? Yes, it is. Is ADX above 20? And it is definitely above 20. Right. So in that instance there, that meets the rules for a breakout. Right. So if in fact you were watching the market this morning, and I'm not sure if it sort of stayed there long enough. I wasn't in a position to be looking at the market that much this morning, but today it met those rules, and if it had held up there for long enough, we would have been looking at this as a potential breakout trade, right? So we would enter into the position, right? Now, if the trade meets the rules, right, we'll go and do the trade. So let me just bring ourselves back into our implied volatility system and just have a look at pricing this up. All right, so the market, well, Coles has really come off since then, which is interesting, but we'll come back and talk about that in a moment. As much as possible when we're trading, we want to be system-based and sort of not getting too caught up in what's going on. I think I priced a lit long on Coles up this morning, so this would have been the position. Now, all of these numbers would have changed slightly, but basically it's saying your max loss is 25 and your max profit is 75, right? So for someone going along at this position, the numbers weren't quite that earlier, so that I think that would have improved, right? You can go into that position. Now, so what are we looking at here? So how many contracts do we want to do? So let's increase that by 50. All right, now in the current market, you can see my max loss is 1,200, my max profit's 3,750. You know, with the volatility, and if you want to be a bit more conservative, you can actually trade with, and I would consider that, you know, you might think about looking at trading with smaller amounts of risk. So where you might have taken a trade at 3,000 risk, you might take it at 2,000 risk, or whatever it might be, because the max profit might be slightly better on the upside in some instances, right? So what we're saying with this trade is we want the price to go up, right? But time's working, once we sort of, we get up here, time starts to work in our favour, all right? All right, so right, so if you go for a run, you can have a look at that's sort of how the trade behaves, right? So that is an example of a lit long. Now, what we would be looking at with that trade would be, okay, well, what if we get it wrong, right? So at what point...
Pat, I was just going to say, you put that in, I think, a little bit earlier before the market decided to go on and completely collapse. So you would have probably been looking at slightly different strikes if you were doing it right
absolutely.
now.
Yeah, you would be looking at
so that's why it looked a bit weird on the screen.
Yeah.
Anyway.
Yeah. And so what's the price? Have you got? I don't have both screens open at the moment, Ivan. But can you tell me what the price right now on Coles is?
It is 1681.
1681. So on this particular trade, where do we turn bearish? Where do we say, okay, it wasn't a breakout, it was a fake out? At what position would we move to switch that? And we'd be looking at this 50-day moving average here, at which point we would switch from the trade that we're currently in and move into the trade that we're doing. That lit position was at the money. In this instance, the strikes have changed because the market's moved since we put the strategy together. But you would be buying back the sold leg, and then you would be in a straight put option, right? And then we'd be trading that retracement. So we don't, some of the biggest trades we've made and best trades we've made, or definitely without question the best trades we've made, have been where there has been a retracement. And instead of being a breakout, it was a fake out. And we showed this example the other night, where this is exactly what happened, which was in the last options trading game. And also this is a trade that some people did. But in the last options trading game, we only placed one strategy. And that was, let me go back, that was an XJO lit long. I'll just click us back in time to go back to those rules. So when we got into that position, let me just clean this up. Sorry, I did do this earlier, and I don't know what happened. Anyway, here we go. So
you and your computer skills.
Sorry?
You and your computer skills.
Yeah, now it's my turn. So this is the exact same scenario where when we were up at up at recent highs, and this is going back onto the 20th of Feb, we're in exactly the same position. We're looking at trades. Technically, if you followed the trade, the issue isn't whether you're right or wrong, but we were setting up these levels, Ivan and I, and those of you that were sitting on our sessions, and we were talking about long strips. I was trading long straddles, feeling like volatility was too low for what was going on, but still trying to trade technically off key levels. And so a key level for us was and it for a little long. Now we traded slightly different strategies at that point in time, but in this instance, if you'd gone long, you would have stayed long. So I'm in the tester, and anyone who's on the platform, and if you want to get access to the access, you can go back and you can test anything that we ever talk about, any of your own trades, trading rules. It's built into the system, and it goes back to 2015. Am I right? That on market on options pricing, so you can have a look at options pricing through that and just go and test anything you'd like to. So in this instance, we're just going back to the 20th of Feb and saying, if we did a lit long, what would have happened in the days ahead if we did trade, right? So we're working on that our max loss was $2,700, and the max gain, well, that's depending on whether we have to do a repair or not. So on the 21st, the market came off, and then we had a big sell-off the following day. So at this point in time, we'd be quite nervous about being a bullish trade, right? And we'd be at the point of considering whether or not we were going to go long. At what point, if this 50-day moving average was going to break, we were going to need to be ready to actually switch from the bullish position we're in into a bearish position, right? the following day that occurred. So at that point in time, if we click there.
You just completely dropped out there, by the way, just for your info.
Oh, did I?
Yeah. Your internet.
Our rules would indicate that we now need to move into a short position, and that is what we did on that particular day, right? And so we then went into a straight put. Now we went through this example, and you know, we can see the profit here jumped up straight up the following day with the continued sell-off to $5,700, $7,000, $19,000, $20,000, and then I won't bother going into it anymore. But you know, I think the end result was like it was up $80,000 from that initial trade. So that is positioning ourselves. So we're not, you know, the best trades we ever do is when it goes against us. In this instance here, if you'd done this trade this morning, then you'd be looking at this level as the level where I put my protection in, where I switch my position, I should say, and I'm in a straight put trade. So they're the rules around, I think I've got a slide on it here. Where do we turn bearish? It will be on this day here is the share price below the 50-day moving average, right? So they're the rules that we're using. You'll probably see there will be a couple of defensive stocks that might be able to, like Coles and Woolies, that might be able to test those 52-week highs. But by and large, what we're going to be looking at is going to be bearish trades, all right? Now, apologies for the slide here, but I'll bring up, I'll put it on full slide mode to make it a bit easier. You know, we were looking for examples in the market, and so I put this slide together quite quickly, but we're looking at Santos, right? And it's cracked through a 52-week low. So the questions on going lit short would be, is the share price below major resistance level? And it will have been, but the other question is the overall trend down. And so the adjustment to that trend can take a little bit of time. It doesn't happen immediately on a sell-off. So what we can now see is the 50-day moving average has moved below the 200-day moving average. And the next question is the share price below the 50-day moving average? And yes, it is. Is the 50-day moving average trending down? Yes, it is. And is the ADX above 20? I can't actually see on that chart, but I would say it would be well above, right? So that would be the rules to say let's short, right? Now, in the current market, you know, there is a lot of volatility in the market. So the usual trigger, as in we had with the lit long, would be that our trigger to switch to a straight call option and then be bullish would be the 50-day moving average. But you can see how far away the 50-day moving average is. So clearly going to that level isn't going to be much of a repair strategy. It's going to be too late if that's in fact what you do. So I'm just going to go back to, we'll go back into Santos and have a look at the chart. And Ivan, in this market, what would you suggest would be the repair that you would be using?
So it is a tricky one. I'm thinking about it. I mean, typically, you know, as we've discussed on Monday, the strategies that I'm doing are in condors, or I'm entering into sort of legging into them. So the things that I'd be looking at with something like Santos would be, you know, you put in your first, the put side of the bull put side on a stock that's come off a fair bit, like let's say a Santos, and then as it pops up to around about, you know, 4-ish, I'll then try and put on the call side. And so literally I'm just assuming that this volatility is going to continue, prices are going to continue moving around. The one thing I don't like about Santos at the moment is it just had a straight line from sort of $5 to $3.30. And so you think that 4 would be somewhere about the point of 4.50 or something would be the point of gravity, but you just don't know how much further it's going to fall. But if you're interested in taking a view on a stock continuing to fall, so I know I've seen a fair few lit shorts come in today, which is, as a strategy, it makes sense, but I think you've just got to have a look at and think about it from 2 points. One is, do you do the repair at all if it goes against you? So one possibility is just to go on and say, okay, look, I assume that this is going to go, it's not going to go my way, that's fine. And then you've got sort of the follow-on question from that is, if you do repair, how do you repair in light of the volatility in the market? Because the volatility is so high, you've really got to start thinking about it from a logical point of view and saying, okay, well, if I'm going to go and my repair is to go on and buy back the sold option and effectively be in a long in the money call, okay, volatility will still impact the price of that option, just even though it's in the money. And so what then happens is, if the market continues going higher, or let's say today is the low for the entire market, and let's say Santos, massive oil recovery, goes straight to 6. Although you'll make money on your call, you're constantly swimming upstream against the heightened volatility. So as the market goes up, volatility will come out of the market. Let's say a vaccine's being created and tested and it's out of the market. No one cares about coronavirus anymore. Volatility is going to go right back down, in this case from 125 to sub 20 or sub 30 at least. So and then that'll completely kill the value of the call option. So it's very important to go on and say, okay, well, if I'm going to go on and make an adjustment, then, or a repair, how am I going to do that, which is sort of neutral to volatility? The best that I can come up with on that is one of two options: either going and buying back your in the money call option, but then selling something that is out of the money, so turning effectively your bear call into a bull call spread. Or then alternatively, the flip side to that is actually adding another call option and then so buying like a bull call option on top, which would create a bit of a ratio type outcome. So that's another thing is, but again, it's sort of a tricky thing. So I think that the thing that we were talking about last on Monday in the evening was really looking at some of the quality stocks that you're looking to buy. Go into bull put. Go into bull puts with the sold leg somewhere in the money. And then if you get it completely wrong, you'll end up owning the stock. If you get it really, really wrong, you're protected. So I think that the repair in the case of the market actually going up is probably not an options repair. It's actually moving to stock. Is probably what I'm thinking, because the volatility is then no longer impacting the price. Or a synthetic, for that matter. What do you think about that, Pat?
Yeah. Look, I'm with you. I mean, a couple of things here is Raquella has said, can we listen to this later? It is being recorded and we will send it around. Stuart, can you clarify your question on the NASDAQ, please? ZM on NASDAQ, please.
We don't have access to NASDAQ would probably be the easiest solution to that.
Yeah. So the Zoom, right? Okay, Stuart. Yeah, no, we don't.
No.
So
but it actually might be a better web conferencing software in light of bad internet connections, Patrick.
Yeah. You mean Zoom might be?
Zoom, yeah.
Well, I beg to differ. I've been using it for the last couple of days.
Zoom, yeah.
Yeah, I think Zoom, for those of you who don't know, is a online meeting, bit of technology, and I think I'd be interested to see what the share price is doing. I know one of the guys, one of the technology guys that works for me, bought shares in Zoom a month ago. That was his speculation of what was going to happen with coronavirus. I haven't seen what the share price has done.
Absolutely screaming it at the moment. So yeah, it was sub 80 a month ago, and I think last saw it on the news. I think it was yesterday, the day before, or something. It's up above 120, or was above 120. So I don't know. I mean, the market moves around so much; it could be 50. But yeah. I think, interestingly enough, I've noticed that we use Zoom internally for our meetings, and we're actually moving ASAP to, we moved to WhatsApp for a bit for doing phone calls, group phone calls. Yep. We're moving off that now into Google Hangouts. everybody's suffering from massive congestion in the pipes. It's just, and Zoom just got absolutely, it's high quality phone calls and whatever else. I have not seen it stack up. So
yeah. Anyway, we're digressing, right?
By go-to.
Yeah, by go-to. So interesting what we're seeing on the XJO, Ivan here. I mean, what's your view? What would you trade today?
I think be cautious. I think that the market is consolidating a little bit, or at least is showing signs of consolidation. Volatility has come off from the market a little bit. We haven't had that sort of continuous drop. I think that you've got to go and have a look at, again, slightly at these levels. You've got to be slightly. I think you've got to have a slight bullish inclination, but not in a way that, okay, the market's going to go up, let's go buy everything, but just in the fact that I think that, if you look at something like that, it's starting to show to me that this is good iron condor territory. I think that, again, you can go in and utilize the volatility to go in and just time it a little bit better. And so if you give yourself enough time, what I think the idea would be is, at this point in time, you've checked your put straight, straight puts, maybe at 4,900 out. In fact, I'm probably going to start doing this as we're talking. But I'd want to go on and look at a straight iron condor to begin with. On that, let's say it's an April expiry. The strikes that are coming in are sort of 4,200, 4,500 on the put side. 54, 50, 59, 25.
29 days to expiry. Yeah.
Yeah. Now I'm probably, full disclosure, I'm probably actually going to go and rein it in a little bit. So I think that I'm going to try and get some 26th of Marches on. But let's start with the 16th of April. But the actual trade here would be do the call side as the market pops up a little bit, and do the put side maybe a little bit closer. So I'm probably thinking of doing sort of a 48.50 type trade, 47.50 on the puts, and then as the market pops up, and I think that eventually it will pop up, even if it's around 5,500, 57.50, adding in the calls is probably the way that I'll go about it. So in other words,
leg your iron condor in. Yeah.
Yeah. That's what I'm thinking.
I'll do both, right? So I'll just set this up. So what level, if you want to do your iron condor now, what would you do your puts at? Your calls at?
The calls I just wouldn't do. I'd literally just leave them. So I'd look at doing them, a little bit later, and probably it just feels like, to me, I think it's just probably 500 points away. So what I'd do is I'd actually close off my puts as the market rallies, and then put in the calls. But again, as we said on Monday night, I just make sure that that you're not risking that much, and you're just very, very, very cognizant of what's going on in the market. And I think that ultimately, as we've seen the last week or 2 weeks in particular, the market started chopping around. So, it's been trading from 4,800 to 55 pretty much non-stop. It's been up and down. And so you can get some of this, I mean, if it's a straight move against you, then you can probably anticipate that, there's going to be a max loss, so try and get out of it as quickly as possible. But I think that, so the strikes there that I'd be looking at probably, where are we? Probably 4,900, 4,800, I'm thinking, 16th of April. 4,900 sold, 4,800. So that's sort of a 1 to 2 payoff. You're only getting the time decay on one of the sides, so you want to try and get the call side on pretty quickly as well. I just think that I'd want to be doing it about 250 points away, at sort of 5,400 level, when there's a bit more value in there.
Yep. Okay. So in this market, you might be more inclined to go into your bull put spread risking less money, but you're getting a better payoff than what you would normally get. And
Exactly.
And saying to yourself when you went into the trade, well, if this breaks away and continues to crash away, then this is just going to be one of the ones I got wrong. Is that right? Yeah,
exactly. So the downside is you're not going to get your decay on the calls, which is the one that sort of gives you some extra benefit there. So your risk reward looks worse at the start. Mine just asked, what do you mean by getting the time decay on only one side? Well, if you've got the put and the call spread in place, then as the market falls, your call spread effectively evacuates to zero. But I think that that's important. So if you get it really wrong, then you're probably going to lose. Well, you don't get the benefit of the calls. But I just think with the way the market's chopping around, it just makes sense to, I mean, is it really going to go down another 20%? Maybe. But then again, I'm going to go then and do the same thing, or maybe be a little bit more bullish 20% later after having lost, a couple of grand on the trade effectively on a 10 grand bank type thing, right? It's kind of what I'm thinking. I think that's probably around about the risk reward that I'd be looking at on this kind of trade.
Yeah. So in this example, if we're able to get a trade on, and if we do nothing and the market finishes above 48.70 is our break even, right, after costs. So if we do nothing and it finishes above there, we'll make money. Our maximum profit will be 49.
About 4,900, yeah. But what's going to happen is, so if you look at it, so purely from a points perspective, so that theoretical is, you're getting 30 points for that, so slowly it's going to decay. If you did something equivalent, if you want to get, where are we, 5,000, call it, right? So if we went and did let's say 5,100, 5,200, even 5,300 spread on the calls, let's say that roughly speaking, that'd be about 60 on the theoretical. So that's your R and condor pretty tight in these levels. But I just think there's more upside. There's just more chance that something's going to come out of regulators. Something's going to happen where you're going to have a bit of a push higher. They're all obviously very concerned and worried. And I think that, yes, if you get it wrong and if it happens very quickly, you probably won't even lose that much. If it goes to 4,500, it comes back to 4,900, you'll still make the maximum profit on that. And then if it goes back down lower and then comes back in and then rallies, then you make an assessment and either you call down, you close your put spread completely if it's, call it's up 10, buy it back and then chuck on call it a 5,500, 5,600 spread, right? And so I think that this volatility, this chopping and changing is going to be around for a while. And I think that's where I think,
Yeah, beautiful. Right, so you can see up in the payoff matrix here, it's waiting for time right down to the very end, right? So I don't know what's the market doing while we're talking through this. Not much. So you can play around with with this type of trade. Let's say you wanted to go a bit lower. You can bring the position down. Obviously, your max profits going down, and your loss will go up. But you can adjust the amount of contracts you've got and play around with it from that. But if you had a view that you thought that it would stay above the 48.50, then in this particular trade you can see that on expiry day, if it's anywhere from that up, you've got a good profit in there. And as Ivan was suggesting, what you can do is then put a bear call in place. If, for example, the market rallies up 200-300 points, you might say, well, look, I think it's going to continue to consolidate. I don't think it's going to break out and run up. Then you can put a bear call in above it, and you've already, sort of hedged that position with your ex-Joe spread that's on, which is giving you some more bandwidth on the way up and a bit more forgiveness on the way up. So as that, say, for example, if the market continued to go up, then you're getting value out of your put spread as it goes up, offsetting what you might be losing on your call spread, and you're getting time decay on both sides of the trade.
Mm. Now, one question that just came up was probably, in terms of, so Mark just asked, do you think volatility will wash out slowly, or is it a volatility crush possibility? And I think this is probably the point that I'm then going to make. So you see how that expiry to the 7th of April, so only a couple of days in there, 9 days or so, in there make a massive difference where the profit doubles. Because of where volatility is at the moment across the board, I'm actually much more willing to go in and take lower risks, shorter time trades. So I think I just want to make the most out of this volatility situation. I think that ultimately the way that the market's going is probably going to go and wash out relatively slowly compared to the past, but that can be like a week. So in the past you could have situations where volatility just dries up one day, selling stops being quite as active, and it falls away completely. Once there's a bit more certainty, I think that if you have something like let's say a vaccine gets announced and it's ready to go, because there's a couple of people that are testing vaccines already, then what you think that ultimately there's going to be one of the biggest short covering events in a very long period of time, massive sort of upside, and I think that actually on the back of that, volatility will probably have its final stand. Typically when the market goes up, volatility drops off. I think in the case of an aggressive short covering, you're going to get volatility spike, or at this point in time holding around these levels, and then shorts get washed out, one final pushback, pull back, and then ultimately it just keeps going. And so that I think that's probably, and of course, it's one of about a million different possibilities that can play out. That's just the one that I'm betting on. So as a result of that question, I think that it's gonna, I think that they're going to be dropping. I think obviously there's going to be crushes, but they're going to be over longer periods than normal. But I think that nonetheless, it's probably like a week type thing, not a month.
But that move involved, just from the small significant in normal context.
Yeah, definitely. And especially because we've been used to this different normal for like sub 15 vol forever. Most people that have tried trading options have never seen volatility above 30. Do you know what I mean? Like, yeah.
Martin, you mentioned the at the money bull put and the example I gave earlier. Can I just put a disclaimer on that, Martin, because I know you're onto these things. We did that example half an hour, 40 minutes to get a current trade idea out, and the pricing that we came up with and the strikes and so forth were no longer relevant, but just the nature of the market moving quickly. And what we're trying to do is bring something current in. But you're right. Yeah, thanks, Martin. All right. So there's a bit going on. We're going to be talking about this stuff. We've got we meet again tomorrow, Ivan, at lunchtime. We'll talk about the next big trade. So I think I'm going to do a little bit more pricing, but I'm looking at some stuff now, so I might get something on this afternoon. I'm going to look pretty closely at that bull put spread that Ivan has been talking about, 4,900, something like that. I think that's probably a trade I don't mind the idea of legging into an iron condor on, see what volatility does over the next hour, I think, and then make a decision from there. But there's lots of opportunities out there. I'd just be, you want to be out there, you want to make sure you've got a plan behind your trade, know what you're going to do. And sometimes there's nothing wrong with just saying, you know what, I'm going to put on smaller trades and allow, not try and put the risk management that I might use in more of a normal circumstances where I can react, or where I've got a clearer range on what's going on, and just, go, okay, well, my upside's significantly larger. I'll trade, maybe even without a stop loss, but I'll just use a smaller amount of money. And allow yourself to do more trades, right? And be patient.
I think that's key. I think that's exactly right. I think that you've just got to be in a position where, a bank right now, you've just got to be very careful about segregating some of these trades. As I said on Monday, just make sure that you're not doing things like I'm bullish CBA, Westpac, and NAB, because if you get that wrong, you're going to get that very wrong. I think most importantly, watch out for the way that bull is at the moment. I think is an amazing opportunity. This is what option traders die for. It's been, we've done the next big trade before it was even called the next big trade. Ironically, as we called it the next big trade, that Webby that we run on Thursdays, there's been some cracking trades in there. But, before that we were running that and it was just like watching paint dry. It's just been, constantly we were just kind of like, okay, well, what are we going to do? And now there's too much to do. And so I think it's an amazing situation, especially thanks to weekly options. You can go on and get things on, that expire on any Thursday in any of the big name blue chip companies and the XJO. So you can get massive time decay in quickly. You're subject to some kind of overnight risk. If you put a trade on Wednesday, on Thursday, theoretically, things might not go quite your way because of something happening overnight. But overall, there's some amazing asymmetric risk in there where you can get some really good payoffs just while there's this period of uncertainty. Although I'm, as we all know now, in isolation, away from human people, the timing couldn't have been better. There's no distractions.
Yeah, and look, and I mean, you're looking at volatility. I mean, if we'll get weeklies on XJO tomorrow, yeah.
Yes, yeah. Well, there's some already. There's the next batch is coming on, but tomorrow is the full expiry of the it's the SPY contract as well. So it's a big expiry. Bunch of rolls happening. But then the next one is the 26th of March, which is in line with the stock expiry. So that's you get, again, this is the interesting thing is, looking at the 26th of March. So I'm just going to do the same spread. 28.50, 27.50 that you've got now. 26th of March is 258 profit to 742 loss on a one lot. Can you just change yours to a one lot on yours and just change it to an April, just so I can quickly compare where the pricing is. At least you've started using that calculator. I'm so proud of you.
I just like ticking boxes.
Yeah. So 259.740, whereas the 2nd of April, the week after, is 397 to 603. So you actually look at that and you go, okay, well, the 2nd of April has got, so you actually you lose less and you get a higher max profit out of that. So that's really worth looking. So yeah, unbelievable. Look at that. That's risk reward, lower risk, higher profit. So it's important. It really pays to go on and do a little bit of shopping around. 9th of April's even better yet. And then 16th of April is bad. So 9th of April is probably, 9th of April is probably where you want to be, which is again, bizarre.
That's a really good point. Yeah. Yeah, I like it. So that's something to have a look at. Well, and that's at 48.50. Now you want it to be up.
I'm happy to be 4,900, maybe even 4,950.
Yeah. Okay. All right. There you go. So yeah, definitely play around with that. We'll be talking about that tomorrow. So anyone who, now I'll just quickly go back to the strategy builder. Where I'm in the strategy builder, I'll go to the scans. So there was this morning we had Coles lit long and we had a couple of lit shorts that have presented themselves. But the big challenge with the lit shorts is about deciding what level you make a decision that you're going to switch from, you're going to go from, in this case, bearish to bullish. And I would say, like, for example, Macquarie, Macquarie Group, which is what am I doing? All right. The challenge, well, first of all, the 50-day moving average is still above the 200-day moving average. So, these trades are there, they're breaking down, but they don't necessarily, it's going to take a while for it to rust on the directional stuff. And maybe there's a good reason for that underpinning this, in that it might be better to start to look at some shortfall sort of positions, or trying to set levels below the ranges that we think might form. But when doing it, right, the rules that I would take into this would be give yourself some space, think about possibly using smaller amounts of money, go for good sized returns, don't be too jittery around it, let yourself take some decent money off the table, but also don't think in context of trying to repair these trades. It's like catching a falling knife, right? If you're in a position and the market breaks down, don't think your solution to it will necessarily be rolling down. I'd be definitely counselling people around that. We want to try and set levels, but if we're wrong about those and the market capitulates and goes down further, it can go a lot further, and you probably just want to get out of its way until it consolidates and you get comfortable about a new level. If you're using smaller amounts, you'll get much higher premiums than you normally would, so you can still get really good rewards out of your trades, but I would be conservative or not greedy about how you were trading those. All right. Regella has asked a couple of questions here. Are you doing investing as a financial manager / broker? Well, we have got a team of, I guess what you would call sort of full service advisors, general advice only, that work with clients who are trading. And then we also have an online service which is supported by phone service, which is really just about helping you get your trades on, where we don't give you the specific advice around your trades or do the phone order for you. We just provide you the ability to do everything online, right? So that's how we operate in the options trading world. In the direct investing, we pretty much just work with professional investors on sort of venture capital, unlisted type opportunities in the main part, right? There are some exceptions to the rule there, all right? So that's generally what we do. All right, so anyway, I think Raquel, you've dropped off the line there. So for anyone that hasn't requested,
loved your answer so much.
Sorry?
Loved your answer so much.
Yeah, yeah, no, come back on. So yeah, Raquel has made the comment. So you become self-sufficient. Yeah, on our online platform and service, which isn't just online, but that is about you being self-directed and us giving you all the support you need to be successfully self-directed. And we're kind of big believers that for most people, that's the most likely pathway to profitability as a trader, because the costs of trading, like if we're talking about a strategy now that we'd look at doing, 2 legs, if I wanted to execute that strategy, I can do it online just by clicking execute strategy, and I can click through to do that with a couple more clicks and I've got the trade in the market, right? But you can do that for, $50, whereas someone using an advisor might be spending, $200 or $300 on the way in and, $300 on the way out, and that could be a big chunk of the profit, or it could mean that you have to use significantly large portions of capital if you're going to trade, right? So we would, the online pathway with support is the pathway we believe is the best one for someone that wants to be a self-directed investor. But look, the people that trade with us come to a lot of these types of sessions, speak to us a lot, have a lot of opinions, do their own research. They're invested in being successful. You want to trade options successfully, and you think it's just going to be something that you can just play with, you're playing with fire. You will get burnt. You do the work, you understand what you're doing, you invest in it, you've got a plan, you follow trading systems and rules and some of the theories that we talk about, you put yourself in a position, we give yourself every chance of being successful. The things that will get in your way will be not having the right technology or having onerously high expenses around how you're trading and those sorts of things. So if you want to get access to our platform, all our education, trade ideas, ongoing webcasts, everything like that, just type in yes. We'll give you a free 30-day trial to it all, and you can get started. I know a lot of people that are on the session today are already clients or are in the midst of doing trials. But for everyone else, if you haven't, type in yes, and we'll get you set up to get going there. All right. So beautiful. Ivan, have you got anything else you want to add to today's session?
I do, yeah. So I've actually just been trying to place this 48.50, 47.50, 9th of April trade. So anyway, there's a bit of delay going on. It's a lot of trades going through, so the market makes the DTRs are being quite careful. The theoretical price is actually
48.50, was it?
Yeah, 48.50, 47.50. Anyways, the theoretical price of 44 is actually seemingly a little bit low. So you're actually probably looking at this. I think we actually will be able to get it in around about 50 credit.
Around what?
Around about 50 credit. But because it's a weekly, there isn't as much market maker support. So it's interesting anyways. But just for anybody who's looking to do that, the theoretical at 44 you'll definitely get done. My suggestion is just hang in there but try and get it a little bit better than that. So the midpoint right now is 47 of the individual legs. So I think you'd probably get in around about that. Market's just moved up 20 points though, so I think that sit there at 50 to 48, and then I think you should be okay. That's me at 61 there, by the way, on that bid. It's just.
How much are you doing?
I just did 2. So, because what I'm going to do is I'd probably go and wait for the market to do something and maybe do another one tomorrow. As in, I only did 2 lots. Tiny trade. So I'd just rather do a lot more of these as opposed to. So if we get another down day, I'll do another 3 or 4 maybe.
Okay, so you're sitting there at 61.
I've actually amended it to 50. Hang on one sec. It just hasn't gone through. One sec. Where am I at? Because I put it to I'm back at 54.
The screen that I'm clicking through at the moment, by the way, you won't see. It's just because I'm an advisor.
It's so much for my 2 lots.
What happened there?
Double me.
Right. All right. There you go.
Yeah.
Right. Well, there you go. So we'll have a play with that, see how we go. Not a huge. Now, Raquel asked, how much is the minimum spend? Is it between $4,000 and $5,000? Now, no. So really it comes down to what you're trading and what potential profit you can make on a position as to where you would come in. So, but yeah, there's no reason. And like for me, even personally, I know one of the guys we work with put a trade on yesterday that he thought was going to be potentially a significantly big one. He'll actually have done brilliantly well out of that. We were giving him a hard time about it this morning, weren't you, Ivan?
Yeah,
down
still was it. Yeah.
Yeah, so it was down 6% yesterday so it's probably down 16% from when he got in. Volatility would have gone on. He just did like a $600 trade or something like that. So, now if I was taking a position where, I was selling some premium and I might get, $500 max profit on a, 2,000 risk, I'd be, that would probably be still okay. If it was $100, then you're paying $25 away and grow, you'd probably be thinking about that. So you just wait up for yourself, but definitely not as high as $4,000 to $5,000 on each individual trade. People ask what's a good size of a bank. I'm sort of between $6,000 and $10,000 is really at the minimum side of it. But again, I started trading 20 years ago with $2,000, and
and now you have 2,500.
And that time, that's what I had. As a young guy, I had just bought a house and didn't have a lot of disposable income, and I wanted to learn to trade, and I didn't want to wait. So at that point in time, that amount made sense for me at that point in time of life. But there's a whole range of different things that each individual will consider before being able to set an appropriate level. All right. So guys, hope you've enjoyed today's session. We're going to be doing next big trade idea tomorrow. We probably won't be too different to this session in terms of we won't do any education. We'll just be looking at trades. If you want to come along, please come and join us. Thank you for coming along. For those of you that haven't requested a trial, type in yes. We'll give you access to our full trading platform. You get access to the scanners, the trade ideas, the back testing, all the online education we do. There's a full education portal that you get access to as well, and the ability to trade options online, do spread trades, do all the valuations and everything else that come with it at the lowest prices in Australia. So just type in yes, and there is no obligation through that trial. You can cancel at any point in time, Raquel. So just speak to one of the guys and give you all the terms and conditions around it. So for those that you would like to take that trial, type in yes. Thanks for coming along. As you drop out of the session, please give us some feedback, and good luck with your trading. Good luck in the market out there, and stay safe. All the best, everyone. Cheers.